Hello everyone, in this video we will discuss fall of FTX and Sam Bankman-Fried. If you're watching this video, you're probably aware that FTX has gone from being one of the largest cryptocurrency exchanges to losing 99% of its value in recent weeks. After declaring bankruptcy and meeting with Sam Bankman-Fried's personal fortune fell from $6 billion to zero in a matter of days. Here's how it went down. FTX is a cryptocurrency trading exchange headquartered in the Bahamas and run by Sam Bankman-Fried, all under the umbrella of ownership with Sam Bankman-Fried, who will be referred to as SBF, the third an American bankruptcy specialist who has become the CEO of FTX for the bankruptcy procedure, has described the business as split four ways with a VCR, a hedge fund or trading business named Alameda Research, and two exchanges, one ring-fenced for U.S. customers. The revenue streams were similarly complicated, but at its core, it made money through its exchange, where FTX took a cut of every transaction. FTX had grown so quickly since its launch in 2019 that it was already associated with some of the most well-known companies, such as appearing on the Mercedes Formula One car and sponsoring the Miami Heat Stadium in a $135 million deal. But as you might expect, their name was removed as soon as they went bankrupt. Much of FTX's demise has been caused by its token FTT, which is directly linked to FTX and effectively shares in the company. Similarly, its hedge fund business bears a large portion of the blame. Caroline Ellison, Alameda Research Wood, uses the FTT token to make risky loans and lumpy bets. Being comfortable with risk is critical. We don't have stock losses very often. These, in my opinion, are not necessarily effective risk management tools. I'm trying to recall a good example of a trade in which I lost a lot of money. Well, I'm not sure. I probably don't want to get too specific, but one of these failed bets was a $500 million loan agreement with a failed crypto lender. To keep them afloat, Sam Bankman-Fried had to transfer $4 billion in FTX funds to Alameda Research. This was never revealed to FTX executives for fear of the information leaking until after the company went bankrupt. This chaotic business model prompted Binance and a major FTX competitor and FTT holder to sell their entire holdings worth $580 million, resulting in the classic bank run. As other customers became concerned and rushed to withdraw their funds, over $6 billion in withdrawals were made in just 2 days, causing the FTT token to plummet by 80%. Consider Northern Rock in the United Kingdom. Given that this video was released a few weeks after the events, we have a better understanding of what occurred in addition to this, and there were deeper issues with the FTX Alameda links. Because the FTX exchange could not accept wire transfers in the beginning, clients would send money to Alameda, and FTX would credit their account. In theory, receiving your money through an affiliate business seems simple enough. However, the money was never transferred to FTX. It was instead kept in Alameda and actively traded in the markets. Worse yet, they didn't make any money. In fact, they lost a lot of money. $1 billion in customer funds, to be exact, money that wasn't theirs to lose, so there were no surprises when people tried to withdraw their money. FTX was unable to locate it. What a shambles, you say? That is similar to what John Ray III stated. Never in my career have I witnessed such a complete failure of corporate controls and such an absence of reliable financial information. And he worked on the Enron bankruptcy raise team, which found $740 million in cryptocurrency. And what he described is only a fraction of what he was hoping to recover now, as one of the major players during the downfall was Binance, a direct competitor to FTX. And the story starts in 2019. But first, Zhao, the founder and CEO of Binance, was friends with Sam Bankman-Fried, and after meeting in 2019, Zhao purchased 20% of FTX for $100 million in order to help grow the crypto economy together. However, that relationship did not last because FTX grew into a significant global competitor. Binance refused to assist FTX with shareholder information when it attempted to obtain a Gibraltar license. The FTX coin. Fast forward to the present, and on November 2nd, CoinDesk revealed that Alameda Research was heavily reliant on FTT. Because of these revelations, Binance decided to sell their entire FTT holdings on November 6, just 4 days later. This triggered a run on the bank, resulting in a liquidity crisis. Binance played an even bigger role, and as FTX was falling apart, Binance offered a lifeline, a parachute, if you will, just 2 days later, and Binance turned to the table to help bail out FTX by purchasing the company. However, according to the terms announced by Zhao on Twitter, Binance had the option to withdraw from the deal at any time, but times were agreed upon, with tweeting a huge thank you to see that. On Slack, he told his team, "Let's live to fight another day. All's well that ends well, I suppose." However, many were surprised when Binance announced the termination of the deal due to corporate due diligence just a day later. It also mentioned regulatory investigations and reports of mishandled funds, with Zhao declaring that whenever a major player in an industry fails, retail consumers suffer. Over the last few years, we've seen the crypto ecosystem become more resilient, and we believe that the free market will eventually weed out outliers who misappropriate user funds. This sounds harsh, but it is correct. As you might expect, the collapse of FTX sent shockwaves through the crypto industry, with many calling for increased regulation to prevent such a disaster from occurring again. Other cryptocurrency lenders, such as BlockFi and Genesis, have also suspended withdrawals at Operation INS due to a run on the bank and in the investment business. Stopping redemptions is a sure way to fail. The cryptocurrency lender has declared bankruptcy. It comes just weeks after FTX, one of the world's largest cryptocurrency exchanges, went bankrupt. Sam Bankman-Fried even stated that an $8 billion cash injection was required to make everyone whole again. Ray has also mentioned a concerning factor. There is no single document that lists all of X's depositors, implying that he does not trust the information in the balance sheet. Did you know that X deposits were used to settle Alameda debts? Are you aware of FTX deposits being used to pay off Alameda creditors? Those who want their money back will have to join a long line of creditors with no special government protection on unregistered trading platforms like FTX. It may appear silly to put so much trust in an unregulated site and so much money in those accounts. Sam Bankman-Fried tweeted that is fine just days before bankruptcy. He finally issued a statement saying, "I deeply regret my oversight failure. In retrospect, I wish we had done a lot of things differently. I'm going to do everything I can to make amends with you and the customers. Even if it took the rest of my life, we could have raised a significant amount of money." Potential funding interest in the billions of dollars arrived about 8 minutes after I signed Chapter 11 documents. Despite everything that has happened in the last few weeks, Sam Bankman-Fried has blamed market pressure for having to declare bankruptcy, shifting the blame to anyone else. He maintains that FTX was a fundamentally sound business that was harmed by market conditions and massive redemptions.